Tax and Jobs Act. And Mr. Lazaro, take it away.
Okay. Just as long as we just kind of mute our phones and make sure everyone saves all their questions, we'll address them at the end. So as you feel a question, you can type it in and we'll address them towards the end. Thank you. All right, so as we get in, we'll talk about what property can actually be depreciated. So really, it's pretty much any tangible property that you're using in your business, anything that you can touch and feel. You got your chairs, your desk, equipment, machinery, cars. Those are the kind of things that we're talking about here. Anything that really has a depreciable life greater than a year. So one example you might think, land, that actually is not a depreciable asset because it actually doesn't get worn down. So like a piece of machinery or a car where it gets used up over the course of its life, land holds its value and you're not really beating it down. So when does this all really start? When do you first begin depreciating an asset? It's not when you put your deposit down on it or send out that purchase invoice. It's when it actually is placed in service and you start using it. Or if you were using it for personal use, you convert it to business use, and that's when you can start depreciating it. And depreciation will end once it's either sold or no longer in service, or has basically been depreciated over its useful life, whichever comes first. So there's a couple different systems to depreciate. So we have all these acronyms on this screen, and what does this really all mean? Basically what it means is there's the maker's depreciation model is an accelerated model. The IRS is actually giving you an alternative way to look at it where you have these IRS tables. So a 5-year asset might depreciate about 52% in the first 2 years, while a financial statement, GAAP, uses a straight line depreciation, which basically takes an even amount over the course of the life. So that same 5-year asset, you're only getting 40% on your financial statements for book purposes, and while you have 52% for tax purposes. So it's an accelerated model, hence the modified accelerated cost recovery. There's actually some elections that can be made if you don't want to take as much depreciation up front. You can either elect to use a straight line method to be in line with your GAAP financials, or you can actually even elect to use an alternative depreciation system using longer lives. So for example, your office furniture, under a normal tax depreciation, the GDS life is 7 years. But you can make an election under ADS to use 10 years. So if you know you're going to have losses or anticipate, you have NOLs that you can utilize, it's a good way to spread the cost of your depreciation out so you're not building up NOLs for no reason.
Thank you, Chris. Now we're going to differentiate what is bonus depreciation and Section 179. So bonus depreciation, they're both used to accelerate your depreciation in the first year, but bonus depreciation is, in prior years, has been a different percentage, 50%, 30%, even 100%, depending on what bill was passed that year. And later on, we'll talk about more about what the updates are on bonus depreciation, but mostly it's taking 100% of the cost, taking all of that as a deduction in the first year. So that's something you want to talk with your tax advisor, see if that's something you want to do, see if that's going to give you a benefit in the current year. Now, you don't automatically have to take it in the first year, but you can also elect out of bonus depreciation. So now we're going to go into what the new law is for bonus in Section 179. So bonus depreciation now has changed from, it was 50% of your cost, now it's going to be 100% taken in the first year if the property was placed in service after September 27, 2017, and before January 1st, 2023. Like Chris said, it has to be placed in service within that time. You can make an election to go back to the old rules and only take 50% bonus depreciation for the property purchased after 9/27/17. And now the new law also allows you to take bonus on used property. Prior law only allowed us to take bonus on new property that the original use started with the taxpayer. So the new rules for Section 179, the expensing limit increased to $1 million, which used to be, I think, for 17 was $510,000, and the phase-out threshold increased to $2.5 million. And this is for property placed in service after December 31st, 2017. Also part of Section 179, they added qualified improvement property. You can take Section 179, which now includes roofs, your heating and ventilation and air conditioning systems, your alarm, your fire and security systems for non-residential property. And now Chris is going to go into how this affects your financial statements versus your tax return.
So some people have, kind of take the idea that this is a gift from the IRS, that they're letting me expense all of my fixed asset purchases. That would be the case if your financial statements are also on a tax basis, but most businesses use a GAAP financial statement, which means you have to use a straight line method to depreciate your property. So if we have an example where we buy a $100,000 asset that would be depreciated over 5 years. The first column is what it would look, the deduction you would get on your financial statement. So you got $20,000 as a deduction every year. On your tax return, however, we elect to take 100% bonus or use Section 179, and we'll get that entire deduction for depreciation in the first year. So year one, we have an extra $80,000 in savings on our tax return. However, when we do our tax return in year two, we're going to have what we call a book-to-tax difference, or also known as an M1. But basically, that's just saying that we have a difference between our financial statement and our tax return. So now, again, our financial statement, we have a deduction for $20,000 in year two, but we do not get a deduction in year two for our tax return since we already took 100% in year one. So that means in year two, we're going to have an extra $20,000 of income that's kind of phantom in a way because you really haven't spent anything. So each year now, we're going to be picking up that extra $20,000 of income. So if you add an extra 0 or 2 to these numbers, it can become very drastic, the add back in later years. And if you feel like that's not going to be something that you can cover from a tax perspective, you got to talk to your advisor and let them know that, accelerating all the depreciation might not be the best thing for me as a business sense, because going down in the later years, I might not have the money to pay the tax. So you add another 0, you have 200,000 now being times that 37% if you're in the highest bracket, which can become pretty significant if your company was break even and now you're adding in more income that you didn't really expect. So I just wanted to kind of point that out to everyone so that they don't forget that this is just a timing difference, not a full expensing. Some of the other changes that occurred kind of also relate to automobiles, but first let's just kind of address what type of automobiles we have out there. You have your regular passenger auto, your sedan, little hatchbacks, whatever you have that are under 6,000 pounds. And when they define the 6,000 pound limit, trucks and van have a little different definition for the 6,000. So the 6,000 for a passenger car automobile is the unloaded gross vehicle weight, which is basically what it is out of the manufacturer. I believe it's probably printed in on the inside of the door or something like that, where you could probably easily find that weight. For a truck or van, they actually let you include the cargo, passengers. So if you have the big toolboxes on the side, those things will count towards that weight when you do this determination. Same thing with SUVs. An SUV that's over 6,000 pounds will get a different result than a regular passenger auto. So if it's under the 6,000, it'll just be considered a regular, like any other car. But if it's over 6,000, we actually get a better benefit. See that on this next slide. So any SUV over 6,000 pounds is actually eligible for 100% bonus. So if you're contemplating buying that BMW sedan or maybe that X5, if the X5 actually weighs over 6,000 pounds, you'll be able to expense or take 100% of your depreciation in year one under the bonus depreciation model. And then for Section 179, if you didn't want to take all of it, you can take $25,000 for Section 179 deduction. Obviously, this is assuming that these cars are all used 100% for business. So part of the new law and the Tax Reform Act, they changed the definition of what a luxury auto can be. So under the old laws, I would say 99% of cars that were new were considered luxury, a luxurious car. So now, under the new law, a luxury car starts at $50,000, which seems like a much more reasonable threshold. So what does that mean now for our cars? So if we actually have a car that's under $50,000, it's not going to be subject to the first year caps that we're going to see on the next slide. Under the old law, so any car over $15,800, we would be limited to either $3,160 of depreciation if we did not elect bonus. If you elected bonus, they gave you the $8,000 that we have noted down below. And then you gradually get a little more and then start depreciating the rest at $1,875 for the remaining period. Now these limits have been increased. So now the $50,000 automobile will get capped at $10,000. And if you take an additional bonus of $8,000, your first year you'll get $18,000 of depreciation. If the car is under $50,000, you'll actually be able to take 100% bonus on that car, which is much better. So if you're contemplating getting that $47,000 car or the $52,000 car, it's a big difference in the tax savings that you can get immediately in year one. One other thing that kind of changed was with like-kind exchanges. So people used to be able to defer the taxable gain to the extent they had proceeds on the property that was either used in your business. So, for example, cars, if you traded in, your truck, and you had 100%, say we had a big truck, we took 100% bonus depreciation, now we're getting ready to trade it in. And if they want to give you $15,000 for that truck, you used to be able to defer that gain into the purchase of the new auto. So the new auto would be reduced by the $15,000, and that would be what we use to depreciate. Now, going forward, under the new law, the only property that's eligible for like-kind exchanges is real estate, basically, real property. So no more trade-in. Once you trade in your car, will it be part of the be able to do a like-kind exchange? So now, if you trade in your car, you'll recognize the gain. Say it was that same example, a fully depreciated truck that we got $15,000. you'll pick up $15,000 of gain and depreciate your new truck at the purchase price that you got it for. I want to just cover, since we're covering changes under the tax law, didn't want to leave any of the farmers that might be out there in the audience left out. They actually reduced the recovery period for the farming equipment from 7 years to 5 years, and now it's eligible for the 200 declining balance versus the 150. So it speeds up depreciation for all the farmers out there. Now Vaughn's going to cover some of the changes to the qualified improvement property that have been made.
Thank you, Chris. So now qualified improvement property. So I wrote these slides like a question and answer, so it'll be easier to understand. So first question, what is qualified improvement property? So basic definition, it's an improvement to the interior portion of a building, which is non-residential real property. Also, the improvement that is placed in service after the date the building was placed in service by any taxpayer. What it is not, we want to be clear on what it is and what it is not before we go into anything else. So what the qualified improvement property is not an improvement to the enlargement of a building, any elevator, escalator, the internal structural framework of a building, or external improvements to a restaurant and restaurant buildings. The day these new laws effective is for improvements placed in service after 12/31/17. So what is the recovery period for this new property? The recovery period, as we explained before, there's two different systems. GDS system, we would say 15 years, and then the ADS system is 20 years using straight line for both. To highlight, I put two asterisks there because the 15-year and 20 years was not explicitly stated in the bill. So we have to wait for the IRS to come out with a technical correction to this to be specific and say, yes, they have 15-year life. So what are the benefits? So if the IRS does come back and say it is 15 years, then we can use bonus depreciation, either 100% or 50% if you elect to do 50%. It also qualifies for Section 179. Other benefits were before, in the old law, we had 3 different classifications of improvement property. Now it's all just one. The prior ones were qualified leasehold improvement, retail, and restaurant property. It also eliminated the lease requirement for the qualified leasehold improvement. So that's another benefit from this new law. So what are the things you need to know about qualified improvement property? So if you're a real property trade or business, which means you are in the business of real property development, redevelopment, construction, reconstruction, all those in the slide, then you, if you are that kind of business and you elect out of the new interest deduction rules, limits that were previously discussed in a prior presentation by one of our colleagues, you have to use these new recovery periods. Non-residential real property, you use 40, residential rental, 30, and qualified improvement property, which is us, is 20 years. Again, to restate, it was not explicitly stated in the bill, so we have to wait for a technical correction from the IRS. So now, what is the qualified improvement property? What are these, not specific to qualified improvement property, just what are the differences in the states for these new laws? So for bonus, as we previously stated, we can take 100% bonus or 50% bonus. In our nearby states, New Jersey, New York State, New York City, and Pennsylvania, they do not allow bonus depreciation. What does that mean? They will depreciate it using makers, just whatever makers is in that year. So you will have an add back that year for that property. And then Section 179 New Jersey and Pennsylvania only allow 25,000 expense, which is also subject to investment limitations. And New York State, so the limitation would be 200K. So if you buy more than 200K in that year, then it gets phased out. New York State and New York City conform to federal law on Section 179, except for when you buy an SUV. So that's what we said. Always check with your tax advisor what is the best method, and depending on where you do business, what is the best method to use, Section 179 or bonus or a combination of both, so you get the most tax benefit for federal and state and, of course, cities. And that is it for now. We will check to see if anyone has any questions. Make sure you type them in so we know what you have any other questions on.